following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show, the John O. Logan Show, where the spin stops here. I've been wanting to do that all weekend. Hope you guys had a good weekend. Man, I took the motorcycle tour around the Sound of North Carolina this Friday, Saturday, before it really started coming out in buckets around here because of that tropical depression. It's a cool ride. You guys should look at that on the map when you get a chance. North Carolina's Sound area is really kind of unexplored. I mean, the Baths, the Belhavens, Orientals of the world down there, pretty cool little spots, but there's some awesome, small towns right on the water, unmolested by the modern era. Very cool spots down there. And the Outer Banks, of course, is very cool, but that's getting a little foo-foo for me up towards the Kitty Hawks and the Ducks of the world. Nice spot. Check it out on the map. Look at it on Google. You'll be impressed. Let's take a look at the Shanghai really quick. Had a little bit of a flash crash on this thing, and also on the Hang Seng. I want to talk about that. But then Goldman Sachs came in and saved the day, of course, again, and said that the China A shares and a couple other things are just going to be one of the coolest things to be in this year. Not a lot of changes in the economic situation in China. U.S. markets are probably not going to, as you look at the U.S. markets, are not going to decline that's a cool thing. 2,100 we're trading at this morning. We closed, well, actually, where do we close that on Friday? Or on Friday, 5:30, let's see here, hold on. We closed at 2097. Had the all-important close on the U.S. markets on the futures above this 2083.20, and we talked about that. That's massive. Now 2083 is going to actually act as support here, and I am going to move my mouse and charts a little slower today. Here we go. Promise. I won't talk in slow motion as usual. Looking at the dollar, this is something, we've talked about. This probably wasn't the stopping point, this 95.65. Just to cover all the bases this morning, we got a lot to talk about. I'm just going to run through the usual suspects. So, already kind of gapping up, coming back. I mean, we talked about 95.65 just being, targets for the longs. Not super interested in shorting this thing. The action this morning, you got 95.65 down into 95.53. That's kind of the DMZ, if you will. And the scanner is going to tell you the same thing. I'm just showing E-signal charts because they've got one of my relatives in a very small bird cage looking thing saying I have to show E-signal charts, or I don't know, something weird's going to happen to them. I'm just kidding. E-signal charts are really cool. I like them a lot. I've used them for years. And Daryl Martin, actually, I believe, said it's one of the best spread tracking charting products you can get out there. There's definitely some downsides to it relative to some other charting packages, but that's an awesome feature. Everybody's got their specialty. So let's go into the dashboard here, and let's look at the futures really quick into the scanner. And what we want to talk about, here's the, where are we at here? I never can find these quick. Here's the cell structure on the S&Ps. There's no red shoots, if you will. got a little bit of a new profile attempting to appear here, but we're going to talk about that. That 2083 area that closed last week really trumps. Did I say Trump? Did he get on our program also today? Heck on it. We're going to take a look at this. Remember, a couple of weeks ago, Steve Banger, who's coming on the show today after the first break, we were talking about, this compression, it's a volatility play by volatility. I was a little bit more bearish than bullish. If you watch this show, you'll know this. But, we talked about, hey, you really don't know what's going to happen here. We've got to look at a volatility play, buying that strangle. Well, that was, obviously if you did that, that was not a bad situation. But now, on a pure trade on the S&Ps, you've got 2083 as massive support. There it is. Here's the sell structure. You want to, if you're going to short this thing, you got to kind of look around. You got to first look at these sells, and you've got to have some reasons to start going short. I'm going to go back to the S&P chart here really quick. I mean, the scanner's saying we might have a new profile attempting to appear here on the daily. It's not showing up in our e-signal charts yet, but the scanner's on top of things. That's a hint of that beginning to happen. But remember, don't get super excited about that. 2083 is the kind of pullback and buy support area on this. I wouldn't get too excited about shorting this yet. All right. Let's hit the notes here. This is one that's just flat out been stunning, shocking, however you want to call it. 129 still support on this. We're kind of consolidating around this area. It's not the greatest thing in the world, but we continue to make higher lows on this as the S&Ps make, do their thing on the breakout scene. I still like this as a long trade with stops below 129, but it's getting, how should I say? It's getting a little scarier because the S&Ps may just continue to go north. So we may have a break there. But again, what's the easier trade? The S&Ps can come off. Shanghai rallying is not going to hurt anybody's feelings here. Hang Seng rallying, a couple other things. We're going to show that on the scanner. But, the notes amazingly are hanging in there. And there's a lot to be said for that. Here's gold. Talked about trying to get some kind of bearing on, what would be the buy point here. We talked about 1,200 being that whole number. And that, we've rallied about, $10 or $11 an ounce off of that area. There's that, there's a 1,200.90 back with, a ways ago. This is our daily chart. We're going to take a look at the weekly. I'm still shocked that we don't have a new weekly profile attempting to appear here, guys, but we're going to talk about this a little bit more when we come back. And we're going to have Steve Banger on with us to talk a little bit about the Fed and some of the rate structure situations going on.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. I think we've got Steve Banger on the phone. Steve, are you there with us?
John, I'm here, if you can hear me.
Yeah, great. Good to hear your voice, man.
Yes, likewise.
How's Chicago this morning?
It's a beautiful day. The sun is shining like yesterday, so it's pretty good. It was a really nice weekend here, actually. It wasn't supposed to be at first, but it turned out really, really nice.
That's awesome.
Yeah,
that's
I
awesome.
agree. Yeah.
Man, I can't wait for you to come down and play some golf around here. But
I know.
You know.
Plus, I need all the tutoring I can get from you, John.
Oh my God, yeah.
As a former professional, right?
Yeah, I've got a package of videos
to
you can
teach me
watch.
a couple of tricks.
Okay. Hey, listen, we were talking, this weekend a little bit about the, what these rate hikes really might affect and the normal course of history of how this, usually pans out in the short term, the long term. I would just love for you to expound on that a little bit if you can this morning.
Sure. Obviously, the financial crisis, we basically only one direction in rates, right? So we went down pretty much every day, every year, or the whole time, up until about the December rate hike, December 2015, December 16th. And that kind of changed the psychology of the markets a little bit. And immediately after the December rate hike, the market went down by roughly 4% within a couple of days. There was the initial rally, but then it kind of had this big downward swoon, two-day action down by 4%.
Right.
And the market rallied back into the end of the year. And then we had the big January swoon, right? When the market went down, when you look at the S&P, about 13% from the top of the range to the bottom of the range throughout January.
Okay.
And that was really the first rate hike we had seen since 2008. And ever since the...
Isn't that amazing? And when you say that, I mean, that sounds so amazing. It took 8 years,
Yes, I agree.
Incredible. Yeah,
I agree. And the Federal Reserve has been adding liquidity ever since, right? So that was the first time that the Federal Reserve really kind of like tightened liquidity, at least as it relates to the official rates. And I think it kind of changed the psychology of the market a little bit, or actually quite a bit. And since then, we have had 3 FOMC meetings which showed no results, right? And every time but one, subsequently to those FOMC meetings, the market sold off again. I mean, the January meeting, the market had a 3-day rally, but then it fell 6%. The April meeting, the market went down about 3% within 7 days. And really the only FMC meeting where there wasn't a lot of action subsequently was the March meeting. And I think that presents a really interesting opportunity because if you believe that the psychology of the market has changed, that the FOMC is not the provider of good news anymore, then the June meeting represents a really good opportunity to short the market for a couple of reasons. First of all, we are running into the presidential election cycle, and there's not going to be any rate hikes later this year anymore. The stated goal of the Federal Reserve was to raise rates in 2016. And depending upon who you listen to, the bets were on that we're going to see either 2 or 3 rate hikes. And if you take any of those things at face value and look at the more recent hawkish data, for instance, the housing stats last week were the strongest housing stats in 8 years, then I think there's a really good chance we're going to see another rate hike in the June meeting. And if you look back at how the market reacted to the December rate hike and how it just didn't take the more recent FOMC meetings as good news, I think it sets up a really interesting short opportunity.
So, what would be the strategy to possibly take advantage of that? I mean, I understand everything you just said. It's extremely valid, and I think everybody out there really, it's great for them to hear that. But as a timing tool, what kind of macro strategy maybe could be taken to try to, maybe take advantage of that concept, in your opinion?
So if the market rallies before the FOMC meeting or rallies into the FOMC meeting, I think there would be a really good opportunity to start accumulating puts.
Okay.
And if the market's just sideways, not going anywhere, you might take a gamble and wait for the FOMC meeting, hoping that the market's going to pop to the upside. And if you get a 1-day pop or even perhaps a 2-day pop, start buying puts. So that would be my strategy. If the market just kind of like trades sideways into the FOMC meeting, if you like to risk it, accumulate puts while it is in the sideways period. But if I'm right, the market is gonna swoon to the downside. And just judging by the last 3 or 3 out of the last 4 FOMC meetings, there should be quite a bit of downside pressure, because even the one where the market didn't have a lot of downside pressure, which was the March 16th meeting, the market pretty much went sideways. It didn't really shot up. So, and there was an opportunity to get out because there was like a 1%, 1.5% give back to the downside subsequently. But I think you want to be short into the meeting and sure enough after the meeting.
Right. Critical thought processes there. So it wouldn't be something really complicated. I mean, the market's going up, the VIX is kind of, pulling back in that type of scenario, volatility is kind of contracting. You're just thinking, maybe buying some puts out of the money, kind of buffering through any type of spikes that might happen, and just keeping it simple, basically not getting too complicated with the strategy.
Yes, I would agree with that. I mean, if you only play for, let's call it a 3% downward move, 4% downward move, which is what we had immediately after the December 16th meeting and the January meeting and the April meeting, I mean, you kind of have to stay with at the money with your S&P puts, or buy some VIX calls. If you play for a bigger move, you can be a little bit out of the money.
Right.
But I believe the key is that the recent history has shown that the FOMC did not generate a pop to the upside.
Right.
So, disregarding the initial pop after the meeting.
Right.
But so consequently, it seems to be a low risk, high reward opportunity, because if the trade doesn't really work out that great, the market should not be blasting to the upside subsequently.
Right. Yeah, I've talked about last time we talked. We were talking about volatility contraction before this. I think we were around, I want to say 2040 or something last time we talked, and we had talked about maybe kind of buying some volatility play, and now we're up 60 points since then, pretty quickly. So that was interesting to talk. Can you stay on for a little bit longer?
Sure, I'm around.
Thanks.
A couple of minutes.
All
right.
We'll be right back, guys.
All right, perfect.
Okay.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Steve Banger on with us. And, Steve, I never really introduced you properly at the beginning of the show. I was just thinking about that. Steve is he was a Merck member. Actually had a clearing firm. At one point, you sold to Revco, right?
Yes, that's correct. Went to Revco.
Back, yeah. And that was back. Well, when was that? That was back in the early
Yeah,
2000s or
that's a long time ago, right? I mean,
right?
the firm kind of like went to RevGo late 2001, early 2002.
Okay.
So, and I mean, I
I
used to
met
be
you
a
right after
member.
that, and you were generally happy all the time after that. I remember.
Yeah, I could speak at length about that, but I won't,
Okay.
because as with everything in life, right, there is a flip side to every story.
Right.
But so I've been in that business for a long time. I used to be a member of pretty much all of the major exchanges, um, starting all the way back to Eurex Live, so the two big European futures exchanges, and then the US here, the CME, Board of Trade, mostly electronic memberships, um, Cantor Fitzgerald, all of that stuff.
Cool. Well, I tell you what, I want. Can we switch to currencies for a little bit because it might relate to some of the things we talked about earlier, as far as rate hikes and
Yeah.
situations like that.
Yeah,
Well,
I just want to say one thing as
okay.
it relates to volatility and where the market is right now,
Okay.
because I want to make sure that it's being put into proper context.
Okay.
The market is obviously right now at its all-time high, give or take it, right? I mean, you're in striking distance of making new historical highs here,
Mm-hmm.
and a significant breakout above that with a closing on a weekly basis about the old highs would certainly signal that we're going to have another couple of percentage points to go to the upside. So in a perfect world, that happens before the FOMC, the June FOMC meeting,
Right.
so that is kind of like off the table. But if the FOMC meeting propels the market into new higher grounds with a close, everything I said before is kind of off the table. You don't want to be short at that point. So if the FOMC actually produces a close into new historical high grounds, you don't want to be short.
Right. Yeah. So I totally hear what you're saying.
Yeah.
That's good historical, been there, done that information when it comes to looking at these breakouts before announcements or breakouts after the announcements. Invaluable. Can we talk about the some of the currencies next?
Sure. Sure.
Okay. Okay. On the euro, let's just go right to the main one here. How does that? I mean, because of the upcoming, the FOMC meeting, the possibility of rate hike, whether the broad U.S. equities markets does what it does either way. Do you see the euro revisiting lower inflection points, or do you think this thing's just going to be just kind of churning around and kind of a wait and see, attitude? What's your thoughts on that one?
Well,
And I
I
guess
mean,
the dollar, the dollar's looking this morning is I don't know if you've looked at it, but we talked about this 95, 60, 50 general area on the dollar. And now we've kind of talked about not really looking at that as a shorting opportunity. It's top of the profile on the weekly. It's kind of edging up, looking a little bit stronger. How does that factor in, you think?
so the last time I was on, I mentioned the fact that the US stock market, in my view, is basically the tallest of all the midgets right now, right? Meaning that the European stocks in general are doing much worse than American stocks, and Asian stocks in general are doing much worse than American stocks. So we're doing much, much better than everybody else. At the time, I think the last time I said that the Euro Stocks index was down something like 24% from its historical high, whereas we are only down 2%. Or at the time, we were only down 2% versus our historical high. So capital flows go to where there is the safest harbor, and that is undoubtedly still the United States. And on some level, that is still the case, and that is what has been propelling the stock market upwards. And I don't see this trend breaking anytime soon. Europe is fighting deflation, and we are, on some level at least, trying to adjust our monetary policy to a more reasonable inflation expectation. So we look much better for any type of currency speculator than the euro does. So the dollar should be stronger and should remain stronger than the euro, just given our basic fundamental scenario.
Right. You know what always astonishes me when I go over to Europe, and I haven't been to Germany in years. God, when was the last time I was in Germany?
You're missing out, John.
Over probably
I
10
know.
years.
Right.
Whenever I'm over there, Steve, I get this feeling it's just a lot stickier, muddier, more cumbersome to really do business over there. You know, that's my. I just get. I mean, I was in London maybe 6 months ago, and it feels like the business environment is opening up more, but it still feels red tape-ish. If you know what I mean.
Yes, I mean, on some level, I mean, there's a reason. Well, first of all,
That's my opinion.
yeah, no, you're right. You're right. Depending upon where you are in Europe, that's definitely the case because just think about it. I want to say like 15, 16 years ago, French, if you take the two European powerhouses, French and German GDP per capita was pretty much in line, was pretty much the same number. Nowadays, German GDP is about 40% greater than French GDP per capita. So the reason why that has happened is undoubtedly because Germany has done a better job of deregulating the economy, making things easier, which then provided an environment for faster economic growth. So depending upon where you are in Europe, I think what you just said makes perfect sense. I mean, there's definitely more regulation in some countries versus other ones. And that, of course, then generates a competitive disadvantage or benefit depending upon where you are.
Do you think, we got about a minute left, and I really appreciate your time this morning. What do you think about the Brexit situation? Do you think that's kind of water over the bridge? It's not anything to worry about, or for the currency market, anything to worry about anymore? It's pretty much in the bag as far as them not exiting, or what do you think?
I don't know. I mean, the problem with the Brexit is that if it were to happen, it might very well be an earthquake in the financial markets because it might signal the end of the European Union as we know it. I think there's a lot at stake here.
Right.
So
and that wouldn't necessarily probably be a bad thing for like the Germanys of the world, which are kind of towing the line more than anybody else, right?
Well, I actually think it would be a bad thing for
over the
Germany.
long term, maybe.
No, I actually think it would be a bad thing for Germany.
Okay.
Because if you think about it, right, I mean, the only reason why Germany is doing better than everybody else, once again, comes from the midgets. They're the tallest midget among the European countries.
Right. Well,
right?
Steve,
I mean,
look, thanks for coming on today. We got another break, and I really appreciate your time. Thanks. Steve Banger, folks. We'll be back.
Right. Thank you, John.
Yep.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi guys, welcome back to the show. I think Larry's going to be back. Correct me if I'm wrong, Al, for the next hour, which is going to be a real treat. I miss hearing Larry's voice. We're going to take a look at the indices, so stay tuned is what I'm trying to say. That was the net result of that statement. We're going to take a look at the the globe here, and a lot of green you'll see. Daily kind of conversions. Saudi Arabia, interesting thing. That thing had really gone ballistic, and we've got a really cool version of the scanner that we built for Mustafa over there, which we've had on the show, showing signals on the Saudi Arabian exchange, and I think he's ecstatic. We're going to convert all that also into the scanner. But as we look at this thing, like Steve had talked about, 2083 being support on the futures. I don't think so, Larry. You're the giant among midgets. So as we look at this and we look at that 2083 on the S&Ps, there's that weekly for high. If you'll notice, I can mouse over this. I can find out where the Shanghai support is, that bottom 2743. Get a lot of information in one glance here. Get a chart really quick. I say really quick. There's that 2083 and get a visual representation of a lot of things you see on here. But I want to go back into the currencies really quick. I want to go back into the Forex section. The scanner has not yet got the alerts in. That is a horse of a job, and we are almost finished with that, Joe from Scotland. We're going to take a look at the Japanese yen. We're going to go down to the bottom here. You're going to notice that arrow 41 down. We've been in a protracted breakdown on the long term for a while, and we're going to take a look at this really quick. Let's just see where we're at. JPY USD, and we're starting to. Let me. Excuse me, folks. Let me pull that back up. You'll see the. We're trading above profiles on the daily. We started kind of having some hints of some upturns on the 240s first. But that 110.40 coupled with the 110.35. Now, what does that mean? Those two inflection points lining up. We talked about not shorting this 110.40 because of the dollar situation, the pressure on that to probably move higher. And the yen trade, we talked about at 105.50 going up into 110.40, 110.35. Got the green shoots on the intermediate, now trading above the unfurlows on the weekly. It's completely at all possible for this thing to rally back into 114.55, 56. And remember that the Japanese government had not wanted the valuation of the yen to happen. I think they're, obviously they've talked about some government intervention to allow themselves to compete a little bit better. The dollar is helping this situation. Here's that 110.35, 110.40. And as we look at this, now this is going to be the support area, the breakout. We kind of started last night or yesterday afternoon, really climbing, and now that's going to be looked at as support. I don't even know if we're going to revisit that area, but next stop up on this, you're looking at 111.78. And again, long-term stops can be below 110.40, 110.35 on the yen trade. I like this even reaching higher. And if we get into that 114.55, 56, that'll be a 900 pip move from the 105.50 area that we talked about. And I hate stealing Tucker's terms here, but the back the truck up trade around 105, 106 that Joey and I had been speaking of. And those are, when Joey was on, we were talking about that, and trading in general, and how you can sometimes make your whole week, month, even year on some certain trades when the stars are lining up, and you can put some really good risk reward trades on. So that type of trade, 105.50, maybe putting some stops below 105. We talked about first target's 110.5, and maybe even higher on this trade. Those are insane risk reward trades where you just kind of step back and maybe even hedge it and just kind of let things develop. And this was obviously one of those times. I mean, a lot of times during the year, it's a chop up game. You're getting stopped out. Hey, not the highest probability scenarios relative to something like that. You got to still play the game. You don't know when, and that's the risk. Some people look at automated trading systems and they look at the signal and they're like, well, it's probably not the time to do this trade. Start putting you've done all your historical background work and all your statistical hypotheticals, and then you start playing with the system moving forward. It's just, then you're killing the system. So this is one of those times where, again, got to keep turning the wrench the same way. Every day you go to work and playing the probabilities, and some of these don't work out, but you're going to get massive wins every once in a while, and you got to be in it to win it. So that's my take on that. Let's look at the Australian dollar. This is another one. We talked about this 71.69 area. Why? Big number from before when we broke above and started getting that momentum based on a divergence that was happening down here. All right. And, we started, okay, it's time to possibly start nibbling, but that was a telltale sign above 71.69 to just step on the gas pedal. We talked about playing against that recently, stops below. I think Dave from Clearwater was on, and we were talking about this and placing some stops below. And where's the targets on this type of trade? The targets are, and this is all in the scanner, folks, 73.42. So again, you got a 200 pips situation. I still think we're going to rally up here. China doing supposedly better. The market in general is going to bode well for a currency that digs holes and sells things in the hole to China. So again, I think we've got some more upside left on the Australian dollar. Let's take a look at crude really quick. And, Joe, we're going to have Joey on tomorrow. Joey's actually in the States right now. He's in San Francisco, or I think he's actually going down to meet a friend of mine towards San Diego in Carlsbad. So we're going to try to have him on tomorrow, and we'll talk about the flash crash mechanism that happened overnight in China and Hong Kong. But that was the DAX there. Let's take a look at crude really quick. And here's the situation on crude. So, Canadian dollar is, we're going to take a look at that after this. I wanted to show this first. Goldman Sachs, I think, started talking about getting long in a big way around 47, I want to say, 48. And, this thing's kind of elevated. Technically speaking, right now, 48.97, 49, big support on this. I haven't been a big fan of buying crude up here, but pure technical analysis, this is looking launching paddish, if you will. And we're going to take a look at the weekly here. And no long-term signs that this thing is going to be turning around. I'm waiting for that to happen. But all the things going on with the U.S. stock market, and a couple other things are not allowing this to happen yet. We'll be right back, folks.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, guys. Welcome back to the show. We're going to take a look at new crop beans, November beans, really quick. Talked about this area last week when we looked at this 1063 and a half. Backed off of there, kind of crowding it again. The weekly, the long term, again, we're using the daily to kind of regulate that trade stop oriented situations on the long term. Man, this does not look very pullbackish now. We had a little bit of a break there, back in 1038 and a quarter, somewhere in there. And then we got back on the horse and reached the targets quickly. Now we're crowding this again. This is not what you want to see if you're short, folks. This is playing with fire to short this. The volatility play, there's a lot of options you have here when something's in this type of state. And, being long soybeans, long in the money puts, I still think, long a strangle right now, even at this level, is not a bad idea. You're going to have some volatility, as John from Philadelphia has spoken a lot about. I mean, you've got some upcoming events. You've got some weather scares that are probably going to happen. You've got the South American thing going on and a little bit of a numbers game going. I mean, there's quite a few things you're going to have that are going to kind of herky jerk this thing around in the near term. So a lot of opportunities there. All right. So as we look at, we're going to go back and look at an ETF or two here. Let's take a look at the XLE. So trading 67.20 this morning on the XLE. This has been something that, I've been looking to this, a little bit disturbing, crude going higher, this thing not really wanting to participate in a big way. But again, nothing to really short. I mean, I'm just looking at this as an indicator to try to figure out where the spine might be broken on crude, if that's going to happen. But again, been staying away from crude on the short, just passing along, staying away from crude on the short side. Because there really hasn't been a lot of red shoots on crude yet to really start looking at that from any other angle, then it's okay to be long, not okay to be short. That doesn't mean you have to be long. So looking at the profiles, that's kind of the way, in my simple mind, can block out one side of the marketplace. In that case, don't have to be long, okay to be long, not okay to be short. Okay. Going back to the scanner, we're going to take a look at a couple of stocks that just completely have not participated lately. I'm going to go down into strong downtrend. There's 4 stocks in the S&P 500, by definition, that are in a strong downtrend. TECO Energy, Symantec, CenturyLink, American Airlines Group. Here's some of the stocks that have kind of come up into resistance in a downtrend, kind of popped their head up, the whack-a-mole situation, if you will. Let's take a look at Fossil. I ordered some watches from these guys. Are not this is an ugly situation. How do you trade it? You don't go long. It's that simple. And it's rallied back up into daily unfair lows. Here's Google. Let's take a look at this one. This is one I think we should stay. This is not the best opportunity. Hormel Foods, this is one that we've been talking about for a while. Not an exciting trade, but you've kind of got a new profile here. You still closed below it on Friday, or we're out of time, folks. I hear the music. Stay tuned for Larry, guys. He's back.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.